Good to have you back. Today, I will talk about the financial instrument called Treasury bills, also known as Gilts in the UK. Please note, these investment vehicles are also known as government bonds, and I will examine how you can use it to generate consistent income and why you should include it in your portfolio. To hedge your portfolio. Meanwhile, this is for financial education purposes. Thank you. So grab a cuppa, of course, a cup of tea, and then subscribes. Remember, our target is 500 subscribers. Thank you. And you may hear me mention treasury bills and gilts in this video. Like I said, it means the same thing. They are both government bonds. Okay, now, what is treasury bills? Well, in simple terms, it is a loan from you and me, the investor, to the government. Well, you could say the government borrows money from us and then issues the investor a bond as an agreement of contract and pay a fixed interest rate to the investor until the bond reaches its maturity date. And then at maturity, the government pays the principal, the full amount that was initially invested. And government pays periodically every 6 months through a system called coupon payment. Meanwhile, treasuries are classified into 3 types. How? Well, it depends on their length of maturity. For instance, bond with less than a year maturity is called bills. Bond with a maturity fewer than 10 years is often referred to as notes, while bond with a maturity of over 10 years is called bonds. So, what is the implication of years of maturity? Good question. You see, in effect, it means the longer the maturity dates, the higher the yield. Okay, that's said. Another good question is to ask is, why would the government of a country initiate this strategy? To decide to sell some bonds. Well, stay with me. Let me break it down. Now, you see, government bonds are sold to raise money for government spending. It could be for infrastructure or daily community projects. And this strategy is often deployed by government of most countries to raise cash, mitigate risk, and plan for the future. For instance, in the UK, gilts are used to help with future developments for pension and life insurance market. Meanwhile, this is key. Please listen to this. To inform you, from bonds in Germany to OATS in France, bonds in Ghana, bonds in Nigeria, gilts in the United Kingdom to treasuries in the US. They all work similarly, regardless of their name or country of origin. Moving on. The question is, why should you include treasury bills in your portfolio, and how is the yield calculated? Okay, now stay with me. Let me explain it. You see, based on past and ongoing analysis, UK gilts or government bonds have yielded consistent, reasonable returns for investors and traders alike. Besides, it can be used to hedge your portfolio, balance your portfolio, to diversify your portfolio from corporate market. And UK bonds are considered a low medium risk. If you ask me, I say I'm just okay with this, provided my money is safe. I'm in a safe hand. Alright, don't go yet. Let us examine how the yield is being calculated. Now, to do this, let me quickly borrow this instrument here. Now, let's say, for example, you decide to invest £5,000, okay, £5,000, okay, into the foreign bond, say year 2021 to 2031, 2021 to 2031. That's 10 years. Okay, fine. So 10 years duration. Now, let's say the coupon rate is at 5%. Now, And the maturity date, like I said, is 2021, 10 years. Now, this means that you will receive 5% of the bond annually. And it's going to be semi-annually, 6 months interval. So, let's say 5% of 5,000. Let's do the math. 5% of 5,000 give us equals 250 pounds. Okay? Now, we're getting somewhere. I suppose you are with me so far. 250 pounds. Okay? Alright, now. So, however, if you hold on to the bond until maturity, and remember your initial investment is 5,000 pounds, and then our coupon now translate to, from our calculation, 250 multiplied by 10 years, which equal 2,500 pound. Okay, fine, we're getting somewhere. Now your total will be 7,500 pound. Therefore, you receive a 50% profit over 10 years. Now, wait. Don't go yes. Very important to let us examine what factors always influence the price of government bonds. And I want you to note this. The key element here is interest rate. Now, please let me get rid of this before I continue. Let's get rid of this. Great. Now, like I said, the key element here is the interest rate. So, now, stay with me. If interest rate fall, bond prices generally rise and vice versa. A bond's value is determined by its coupon yield relative to the country rate of interest. Still unclear? Wait, let me break it down further. Let me use another example. For instance, if you own 5% coupon worth £100, if you invest in a bond worth £100 at 5% interest rate. Meanwhile, after your purchase, the government decides to reduce or increase the interest rate for some economic reason. It could impact your initial investment in 2 ways. Let us examine scenario 1. Let's say if government increases the interest rates, the cost of borrowing increases. And let's say the bonds are now being released at 7%, while your coupon only worth 5%. Consequently, the demand for your bonds fall, reducing it to £95. 5% of 100, that's £5. 100 minus 5, £95. Let us examine scenario 2. If interest rate fall, the cost of borrowing reduces, and bonds are now being issued, for instance, with a 3% coupon, meaning your 5% coupon is now worth more than the new coupons. In effect, most investors looking to buy a bond will rather purchase one with a higher coupon rate than the current interest rate. So, invariably, the value of your coupon increases to £105. So, the question is, why and how do you buy bonds in the UK? Well, banks like HSBC, Barclays, and Lloyds are large financial institutions. And large financial institutions are usually the first to access government bonds. These bonds can be sold to smaller financial institutions and individual investors and traders like you and me. Okay, here comes the best part. Subscribe and like. Remember, our target is 500 subscribers. The goal is to generate wealth, build companies, and then create jobs. Bye now. See you soon.